Okay, let's talk about something you probably hear about but might not know what it is. Haircuts. No, not the kind you get at a salon. In finance, a haircut is a powerful, often invisible tool. We're about to pull back the curtain on a hidden data system that uses these tiny little discounts to keep our entire global market from falling apart.
So, to get what I mean, just imagine this. You've got an asset, right? Let's say it's a bond worth exactly $100. Seems pretty straightforward. But then, the second you try to use it as collateral, as a guarantee on a trade, the system looks at it and says, nope, to us, that's only worth $95.
And right away, you're probably thinking, wait a second, where did the other $5 go? It didn't just disappear into thin air. It was taken off the top on purpose. And that's the real mystery here. Why? Why does the system do that? Well, that missing $5 has a name. It's called a haircut. And it's basically a percentage that gets shaved off an asset's value. Think of it less as a loss and more as a safety buffer. It's a cushion for the lender, just in case the value of your assets suddenly drops. It's all about managing risk.
This brings us to a really core idea in finance. Not all collateral is created equal. That haircut isn't just some random number they pull out of a hat. Oh no. It is the end result of a massive, ongoing risk calculation that's constantly sizing up every single asset out there.
So, how does this system actually decide how big of a cut to make? Let's get into it. We're going to look at the actual rulebook and see the logic that determines how big that safety cushion really needs to be.
The whole process is actually pretty logical, almost like a simple piece of code. First, the system identifies what kind of asset it's looking at. Is it a super safe government bond or a riskier stock? Then it checks the maturity date. Is it paying out next year or in 30 years? And based on just those two things, it applies the cut.
And it all boils down to two really simple but powerful principles. First, the riskier the asset, the sharper the blade. Makes sense, right? A volatile stock is going to get a much bigger haircut than a stable government bond. And second, the longer the maturity, the deeper the cut. There's just so much more time for things to go wrong with an asset that doesn't pay out for decades. And here, we can actually see the numbers in action. This is from the OCC, the Office of the Comptroller of the Currency. And just look at the difference. A U.S. Treasury bond, it might get a tiny haircut, less than 1%. But corporate bonds, a little bigger. And equities, stocks, whoa, they can get a haircut of 25% or even more. This table isn't just a list, it's a peek inside a massive database of risk. This chart just makes it so incredibly clear. Look at that one-year Treasury bond on the left. It's considered almost risk-free, so it gets a teeny tiny 0.5% cut. Now, look at a 15-year Treasury, same issuer, but because of that longer time horizon, the risk jumps, and the haircut goes to 8%. And then you have equity, all the way over there at 25%. You can literally see the system's risk calculation right here. Okay, so we've seen how it works for one asset. But now, we have to zoom out. Because these little cuts don't just happen in a vacuum. They create these massive ripple effects that are felt across the entire financial system. I love this quote because it sums it up perfectly. When the market gets shaky and people perceive more risk, the system reacts. The haircuts get deeper. And when that happens, the total value of all the collateral in the system just shrinks instantly. And that shrinkage, it hits the core plumbing of the financial markets. It changes margin requirements for traders, it affects how much money clearinghouses need to keep in their emergency funds, and it even changes how regulators stress test the banks to see if they could survive a crisis. Everything is connected. The scale of this is, well, it's almost hard to comprehend. We're not talking about a few $1 million. A tiny change to the haircut rules, just a percentage point or two, is applied everywhere, all at once. It can change the value of trillions of dollars of collateral moving around the world. Trillions. So that brings us to the most important part of this whole story. How on earth is all this managed? Well, it's all run by a massive, constantly evolving database. A database of risk that works silently behind every single trade. And this database isn't static. It learns. It gets smarter. Look here. After the 2008 crisis, the system updated its rules. Regulators issued new memos. The same thing happened in 2020 with all the pandemic chaos. Every major market event becomes a new set of data points that recalibrates the entire risk database for the future. And that's really the key takeaway. Every single haircut is a single data point. And when you put them all together, you realize that the entire global collateral system is really just one of the most important databases in the world.
a living, breathing record of financial risk. And that data is always on the move. It's constantly flowing into regulatory dashboards, it's powering the margin engines at clearinghouses, and it's feeding the complex models that supervisors use to try and predict where the next big problem will come from. It's the data backbone of the whole system.
So, when you put it all together, you see it. These haircuts aren't just some little cosmetic discount. They are fundamental structural safeguards. You can think of them as the automatic braking system for the entire financial market. And the whole thing is powered by data.
But that leaves us with one final, pretty big question. We've built this incredible data-driven system to try and keep things safe. But today, in an age of high-frequency trading where markets can swing wildly in milliseconds, can our data and our system ever really move fast enough to keep up? That's the challenge we're facing right now.